My name is Sebastian. I started at Amorelie with Leah, who can't be here today. We met a while ago, both in consulting, then both worked for internet startups and in venture capital, and then at some point had this seemingly crazy idea to pretty much target one of the very basic elements of human life, target love life, and actually make it into a site that looks more like a Zalando and more like a fashion site, really like a premium site that targets the cosmopolitan readers, so especially women. Yeah, that's Amorelie. We started the company 2 years ago, have been building a brand ever since, and this is also actually one of the very vital elements. You just saw our TV spot, you see our website, so this is a business where building a brand is really, really important. It's not only about performance marketing. That's something that we thought when we entered the business, both from a rocket, thought, okay, we can conquer the world with SEM and SEO. Actually, in our case, that doesn't really work. You have to build a brand, and you have to become the top-of-mind brand. Okay, we just saw the video. Yeah, so what does that mean for us? So we, in the beginning, we got started about 2 years ago, January 2013. Tried those rocket methods of performance marketing that worked a little bit, but we actually we had to go through through a tough time of finding out how this PR thing works, how branding, building a brand actually works, how all these different, not so tangible channels actually work. And we did a lot with that, and we actually found our personal blueprint for building a brand and for translating brand into sales. And one of the very important steps in that trajectory was definitely our Series A, when ProSieben already became a part of our shareholders. So they, back then, in a media for equity and also cash for equity deal, they acquired 23% of Amorelie in, what was it, December 2013, so pretty much a year after we launched. Yeah, and ever since, so we've been on a growth trajectory ever since. I think in our first year, we had 7-digit revenues, and then in our second year, 8-digit revenues. This year we'll at least triple revenues once again. Yeah, and then in the beginning of this year, we actually sold ProSieben, we sold Amorelie, 75% of Amorelie to ProSieben in a deal that had actually had a history. So we actually intended to go out fundraising in, I think, September of last year. And then, of course, since ProSieben was one of our shareholders, we told them and all the other shareholders, hey, we're going to go out fundraising. How much of the round do you want to do? And all of them said, I'll definitely do at least my pro rata share. Then there was one player who said, I want to do a lot more, and that was ProSieben. So we worked with them. They saw how well we performed, how well our TV spot performed. And yeah, they actually, through a lot of conversations, we ended up at this mode where they said, we don't only want to take a large portion of the financing round, but we actually want to acquire Amorelie. But ever since, I mean, so that was in September, and these conversations took a very long time. And then actually in April of this year, so a month ago, we actually finally closed the transaction. Leah and I still hold 25% of the company. We will be with the company for a few more years. Yeah, so for us, this is probably one of the ideal types of a transaction. And I think we'll talk about the details later, so I won't talk about it now. But I'll quickly talk about why I think ProSieben was such a good fit. There are 3 key things that we looked at. One is the product and industry fit. So ProSieben is the mainstream TV station which targets exactly our target group. So yeah, we saw that there was a huge overlap in terms of their aims and their goals for the future. They just started a 7-commerce cluster, and we're one of the very first companies to be part of that cluster. Yeah, so this was one of our key building blocks for the transactions that we said we want to through this transaction, we want to enable growth and further growth. Then number 2, which is also along those lines, is the strategic fit. ProSieben, they just also launched the European Media Alliance, and we're actually one of the very first companies to work with that media alliance. So it's pretty much the star alliance for European media companies. So we can now use that network to expand Amorelie internationally. And then number 3, which is actually one of the very important points, is the personal fit. So we worked with ProSieben and the guys in Munich. Yeah, and we quickly noticed that there was just a very fruitful cooperation. So overall, that takes me to 5 learnings. Number 1, so definitely make sure that there's strategic fit between the acquiring partner and you. Start early and plan for backup. This will probably take longer than you think. In our case, the entire transaction took almost half a year. Get great legal advice and tax advice, even if it costs a little bit more. Those mistakes that you might make if you don't have it are even more costly. It's really important to have a strong management team in place who already know what's going to be happening, because I was pretty much out of business for 6 months and couldn't really run the business, and the same was true for Leah. And then number 5, have fun. So it's really important, even throughout the transaction, that you always have a feeling that this, I mean, it's almost like a marriage, so you have to be cool and it has to feel good to get engaged. Yeah, so if you want to try it, Amorelie, Heureka 2015, 10% off. Thanks.
Thank you, Sebastian. Next up with me on stage is Jannis Zech. He's the founder of Fiber, which some of you might know as SponsorPay, which is the name the company started. Fiber was sold. Need this. Fiber was sold to an international media company, RNTS, if I'm right.
That's right.
That's right. And Jannis will tell you a little bit more about this company.
Yep. So, who of you has founded a company so far? Who's planning to found a company? Anyone exited a company so far? Okay. We sold the company last year. Was probably one of these transactions where nobody really understood what we're trying to do with it. So I'll try to, shed some light on this. The big green. So we started the company 6 years ago, raised 12.5 million euro. We are today 260 people, 200 people in Berlin, 60 people in San Francisco. US is 50% of our revenues. In March, we reached 320 million users. And what we're basically doing is we're empowering mobile applications to make money by ads. We've built an infrastructure layer to essentially let them centralize all their ad revenues via our tool. This is how the platform looks like. I don't want to bore you and go into details. We spend a lot of time, building this platform, and most importantly, we've pivoted the company 2 times. First time, we started out as an ad network for browser-based games. So early clients were BigPoint, GameForge. Yeah, you remember this. and then, when you look at this graph, right? There's pivots is something which are very scary for organizations. So essentially, the first main pivot was we pivoted from a web-based ecosystem to mobile in-app ecosystem, which was really essentially based on a threat by Facebook, because Facebook basically internalized what we were doing, and we had to think about, okay, what are the alternatives? The second pivot was much more proactive, much more strategic. We basically, listened to our clients and understood that they have a huge problem with integrating 5 to 15 different SDKs, managing them centrally, making decisions on the fly on when to show what user what ad from what provider. And so that was the second big pivot. Today we're 95% mobile. And we have one saying in this company, which is like the only constant is change. And that's especially true in ad tech. The problem is, you have to make decisions now, which then yield results in 2 years. And that's pretty, difficult to do sometimes. So, could have been also dead by now, to be honest. Last year, beginning of Q2, we wanted to raise a growth round, 20 to 50 million. We saw, we found something which is very strategic. We're part of the SDK wallet of some of the largest app developers on the planet, and we were really excited about growing the business. We started talking to a lot of VCs, and among them a financial group called Sapinda Holding, which is really the financial investors behind R&TS Media. And yeah, then they acquired us. And they looked for two main things. Basically, an asset which is growing really fast, and secondly, a management team, which then becomes the board of the company which bought us. So Andreas and I are basically in the board and run this company to essentially, execute a buy and build strategy. We sold the company last year for 150 million euro. We also, with that transaction, we did a funding round, which is really geared towards acceleration of growth. Essentially, the best case, the best illustration of this is not the end for us. This is, essentially the next step for growing the company to a very, very big company. And I think the best illustration of that is we acquired a company last week, actually, called Real Time for 11 million. What are some of the learnings we had? I think we could talk about this for a long time, and I hope we're going to dig a little bit deeper. But I think first and foremost, it's about creating great companies. Yeah? And that's usually hard, and it takes much longer than you think. And you guys have done an amazing job in scaling a business in 3 years. You partnered with a company which then, was already very strategic to you. So I think that's also really important. Yeah, be open, talk to everyone. Talk to your competitors, they might acquire you. Talk to, strategic partners, identify them early in the process, and try to create some commercial agreement so you get to know each other. And then I think, last but not least, this process takes very long. So if you're a small company, you have to judge whether you're, able to essentially sell the company or it potentially kills the company. For example, Real Time, 13 people, they were just scaling their business, and they were very afraid of, losing traction because they had everything else to deal about than essentially, talking with all the auditors and the legal advisors to essentially execute such deals. So, I think it's really important that you, make a judgment decision. When is a good timing, and is that a real deal, or and really drive towards essentially all the major deal blockers very quickly to then either really go in, and then it takes, in our case it took 4 months, in your case it took 9 months. It will take time and energy from your company, and if you're a small company, you want to judge that carefully, because otherwise it might, kill you over time. Yeah, thanks.
Thank you, Jannis. So next up on stage is Martin Steinbach, and the job title on his business card is actually 4 lines long, so I'm just going to introduce him as the IPO guy from Ernst & Young. Thanks. There you go.
Hello and welcome. I'm in charge at Ernst & Young to advise, prepare and execute on IPOs, and this worldwide. My core region is Germany, Switzerland, Austria, but also I'm also in charge for Europe, Middle East, India and Africa, so I can provide also the international perspective. So my goal is to give you an insight in the current IPO activity worldwide, talking a little bit more about the strategic option IPO, because this is only one option to exit or to fund the company, and also talking about investors' demands, because investors are your new clients on the capital market, and what's their view on you as an investment opportunity. And last but not least, how to prepare such an important milestone to go public. So the first insight is about the IPO activity. I think we have a 3 years open IPO window right now in Europe. You see above left, we are at record high on valuation level, so it's quite convenient for you looking at the Nasdaq 100, the German DAX, or the UK FTSE, they are all at record highs, and that means valuation levels are quite high right now. The opposite of the chance or the return for the investor is the risk, and you see below the volatility, and investors don't like volatility at capital markets because volatility is a proxy for risk. And you see we are coming back to normal risk levels, and we are quite at the level despite the geopolitical shocks we all have in Europe, and also the uncertainty about the elections. I think this week we have the UK election, and this all deals with the European Union, with the euro in total, and this might affect the IPO sentiment in total. But now we have a green light to go public, and we had some icebreakers here in Germany as well with Zalando and with Rocket Internet last year, and they are more and more are coming. We heard the announcement of Windeln.de, all driven by new business models, disruptive technology. So the timing is right now to talk about IPO. But IPO is not for everyone. And this is really important for you. This is just an option. And I think you need to further evaluate whether the IPO fits to you, to your objectives as a human being, as a founder, or the company perspective, or the board perspective. You need to judge it on your own objectives. So there is no general rule saying that for this type of business, the IPO is the best route. This needs to be really discussed case by case. In discussions with you as young founders, and may you remember, it took 6 years for Google to go public from zero to IPO. It took 8 years for Facebook from zero to IPO. What about Zalando? You remember? 6 years. And our prestige garage firm in Germany is SAP. The route over there took 12 years. So it's possible to go public in a shorter period of time, 6 years. But first is really to check whether the IPO solution is the best. Just to name one, because my role here is to push IPO or to talk about IPO. The IPO makes you independent. If you sell the company to a large conglomerate, you have no freedom anymore. You have no flexibility as a founder. You are part of a huge group and you can't execute on your vision. So independence is an important benefit. Another benefit is it's also a funding option, not only an exit option. If you look at Google's, Facebook's, and also SAP's development, this really makes those companies to market leaders. And you won't be your goal might be to establish as a market leader and not to stop and sell it to a large conglomerate. On exchange and in public trading, it's all about managing expectations, because nobody pays €1 for the history. Everyone pays a price for your future. So this means also in a 101 IPO test, you need to manage your internal expectations. And these are the global numbers you can expect if you approach an IPO. And an IPO is a project which lots of uncertainties. But to manage these internal expectations, and an IPO really motivates the whole team. I was also 3 years with a firm going public. Typically, 60% of you start thinking about it 2 years before an IPO and then deciding whether it fits or not. 11% taking the route to another destination, for example, US or Hong Kong, not staying here in Europe or in Germany. 15% are exits from private equity, because private equity brings you money, but it's always an interim investor. It's not your end investor. So they need to exit in 5 to 6 years again. 83% executing their IPO on their first attempt. That means 17% are postponing their IPO or canceling the IPO. And you need to have a plan B if you're part of the 17%. And maybe also talking about pricing expectations, 89% are in the book billing range, so the range that is offered to the public market. So you need to have some, if you are part of the 11%, you need to be flexible with regards to your price expectation. Who decides about your IPO finally? It's not the bank, it's not the auditor, it's not the law firm, it's not your PE, it's not you, it's the investor, because the investor decides putting an order in the order book of the bank. If there are no orders in the order book, the IPO won't take place. And those are the success factors from an investor's point of view, from institutional investors around the world. And you see it's clear pricing, but then equity story counts. The right management, the right timing. And I mentioned the timing is, I think, perfect now to go public. And last but not least, you need to be ready. And what means to be ready? You need to be ready in, we identified 8 areas. And this takes typically time, 12 to 24 months. That means you need to decide where is your company sitting? Then where is your tax optimized structure on a shareholder level, on a company level, and also on the transaction level? Is your financial reporting fit, and so on and so forth. So this might be also a journey for you to test the waters in IPO. It's good to start 24 months before IPO. Over to you. Thanks a lot.
Now that we're on the subject of IPOs, Yannis, Sebastian, did you guys ever think about IPOing? Was that at any point on the horizon?
Well, I mean, the company which bought us is public. They're listed in Luxembourg. So I think before that, we didn't really think deeply about it. Now we are public in a very small market. And yeah, there's definitely investments to be made on the compliance side and on the governance side, which is super important. And you know, I think it's exactly like you said. It is a great means to an end to essentially execute on your vision, to essentially access new sources of funding. And that is, I mean, in the current market environment where you have essentially the market's really high, a lot of access and capital, and very little access to technology startups, which are growing fast, that is a very, very good situation to be in. But it's also, you know, for us right now, it's good to be in Luxembourg and then slowly, you know, relist on other exchanges to drive more liquidity in the stock. So yeah, I mean, in the end, we didn't, you know, deeply plan for it. Not yet. I think it would have been too early for us. But now we have to deal with it, and so far it has been very, very good in what we want to do. Yeah.
Sebastian?
We jokingly actually thought about a reverse IPO. We have one, I wouldn't even call it a competitor, who maybe all of you know, who's actually a stock-listed company. At some point we looked at the market capitalization and thought, maybe we should just get so big that we buy enough shares, and at some point, or I don't know exactly how it works, but at some point we actually, we are publicly listed, but indirectly. No, but that was actually just, I mean, we thought about it, but I think our story was more of an organic story. So we actually had this strategic option at some point. We didn't plan on the option being strategic, but we worked with ProSieben for a long time, and it just worked out, and they were very interested, and you know, every company needs money. And for us, it was a great funding option. Now we don't need to fundraise ever again, which for you entrepreneurs, you know how much time it takes, how little time you spend on the business. Yeah, so for us, that was just a perfect option. So we never seriously considered an IPO.
Should they have?
Depends on the equity story. So I think what's required with investors is growth, because via growth, the only reason why investors are investing, institutional investors, is to make money. So it's good for them to invest at the right point of time when your equity story is at the beginning, where you see strong growth in revenue, when you have or when you consolidate old industries via disruptive technologies, this is the right timing for an IPO. And you can also test the waters by meeting them, the institutional investors. They are available in Germany as well as in UK. And if you look abroad to the US in New York and Boston, and spend some time talking with them, getting their view on how to improve your equity story and your vision.
Now, the panel's called How to Find the Right Exit. Do you guys even like the word exit? Because both of you are very much still involved in the company. So for you, it wasn't an exit.
Yeah, that's right. I mean, actually, I never really thought about the name, but in our case, it's definitely not an exit, but it's actually, it's a continuation of a successful story. I think overall that every founder at some point has the urge to, I mean, there are founders out there who want to build an empire and who want to run the empire, even if it's 1,000 people, 10,000 people. If it becomes a huge company, I guess most founders at some point say, you know, I want to move on, I want to do something else. And then in that regard, of course, it's an exit. Although, for example, in our case, we will stay with the company for a lot longer. So in our case, it's definitely, it's not an exit. I guess same for you, right?
Yeah, I mean, for us, it's pretty exciting. So far, I mean, working with the new investors. So I mean, you know, we're definitely excited about the next step. And I mean, I also tried to explain that, right? I mean, in the end, we didn't want to sell the business. And then I think, you know, of course, as a founder, you naturally think about, you know, exit here and there. But I think it's super important to focus on the company, focus on growth, focus on really building something which solves a problem, which is scaling, and which matters. And that's where you start from. And then, you know, at the same time, that doesn't mean you shouldn't think strategically about your different options. You should always do that. And I think this is a perfect example of, you know, I mean, you can just achieve much more if you join forces. With us, it's a little bit, you know, I would say, in our San Francisco office, it's still very hard to, you know, explain what exactly we're doing. But the first thing we did with the R&TS media company is to issue an ESOP to incentivize everyone to essentially, you know, be part of that success story and make it much more successful. So for us, it's definitely not, you know, us selling out, but, you know, in the end, it's a good step at a, you know, very attractive valuation where a lot of our former investors, you know, said, okay, yeah, that's a good outcome for us, and we're excited to scale it to the next level.
Now, how did you guys know that now's the right time to sell? Because, I mean, obviously you think your business still has a lot of potential, and with more potential there comes larger valuation and maybe, you know, bigger exit. So how did you know that now is the right time?
Yeah, I mean, for us, we looked at the options. So between the growth round and, you know, the exit, or however you want to call it. And the deal was just too attractive to not do it. And I think, you know, I'm speaking from my former shareholders as well. So in the end, it was really, you know, you have to look into the details, right? Like in the end, it's really the devil is in the details when you have these different term sheets and you have to make a decision. And it doesn't always mean the higher valuation is the better deal, right? Like in the end, you have to trust the people you will work with, and I think that's equally important. But in the end, it comes down to making a decision, and for us, it was, I think, the right decision. And looking back now.
And I think for us, we were at the notary, and we actually met friends who were also at the notary, to also sell their company, and they sold 100% of the company. We only sold 75% of the company only, so that's also giving away majority. But for us, it still felt good, and I think you always have to have that feeling, especially if you've only been with the company for 2 years. Leah and I see so much more potential in the company, but we actually see that potential now being massively unlocked with ProSieben as a strategic partner with the same goals. And Leah and me still being very much involved and also having a lot of skin in the game, entrepreneurial skin in the game. So for us, it was, it was also the right opportunity, right time, right partner, right personal fit. And then also the assurance that we're not selling our baby, 100% of it, but only part of it, and the rest will continue to push and drive.
Now we've been talking a lot about exits. Whatever happened to actually running a company for a long, long time and growing it and having it being your company for a long, long time?
I guess ideal situation is if you never had external investors. One of the things that happens if you have external investors, if you have VCs, who per se are great investors, but they also at some point they have the expectation of an exit. They want to get their funds back and ideally make some money on it. Of course, there's always the option to buy them out or anything. But so in my mind, that's one obstacle, and then the other one is your personal plan as an entrepreneur. Do you want to keep on managing a company, or do you want to go back to scratch at some point? Do you want to have that excitement again? Do you want to start from zero? And I think that essentially, I think that's what drives most entrepreneurs to at some point achieve some sort of an exit.
Is there a difference between a founder and an entrepreneur?
I don't know. I mean, I think in the end, whoever wants to create great companies, is a founder or an entrepreneur. I mean, I think it's exactly like you said. I mean, in the end, it comes down to, do you want to do this for the rest of your life? And are you, to a certain extent, also incented to do that, or not? And that's, usually when you start a company, you cannot foresee what happens, right? You might have a down round, you're washed out, you're left with, 0.0% of your company, extreme example. Well, do you still want to run that as your baby? Probably it changes your perception, right? So I think it very much depends on, your personal ambition. Am I seeing myself more as a serial entrepreneur, or do I want to grow something very big? And of course, I mean, the role changes significantly. It's very different if you have 20 people to 200 people, or a Zalando with, I think now 10,000 people, right? Like, I mean, that's a complete different way of doing business. If you have the luxury of creating something that big, I mean, I personally, I think that's a dream for everybody, who wants to start companies, to create something like a Facebook, like a Google. It's just very, very difficult to get there. So I don't know whether there's a difference, to be honest.
Right. Did your companies change after they were sold? The company culture, does it feel different?
Our team was actually super, super excited. We actually, I shouldn't be saying this on stage, but ProSieben told us you have to keep this very secret and don't tell anybody. We might have leaked it to our team a little earlier than they wanted us to. So they were actually, we are always very transparent to our team. So they, of course, didn't know right from the beginning, but when it became apparent that this was going to happen, they knew about it, and we shared our excitement about this and about the growth potential. So they actually love it. They have a very strong partner now in the background. I think the only people who don't like it are our accountants, because now suddenly it's corporate accounting, and the monthly closing is not 40 days after the month end, but 2 days. So they have to work a lot more now.
Yeah, I could say the same. No, I think, I mean, it's always scary when these kind of things happen, and I think the most important thing is you have to be very, you have to live that uncertainty. Yeah. Okay, we sold the company. There will be no restructuring. You have to be very transparent on what's going to happen, and then essentially create excitement. And yes, I mean, there's, as soon as you sell your company, recruiters will jump on your team and they'll try to basically rip the best people out. That's at least what we've seen, in Silicon Valley. That's the usual thing you do. you announce a restructuring, you announce a sale, everybody jumps on your people, right? So how do you make sure that you incentivize them in the right way? That was for us the biggest thing, and then really, telling them more about what is the joint vision with our new investors, and also inviting, for example, the new investors to speak to the team and explain what is the plan. If you then have the luxury of telling them, okay, we want to accelerate growth, we want to, basically invest into buying companies or doing something which will strengthen all your position, then I think it's very positive. So it really depends on, I think, the specific case. In our case, we've been lucky with regards to that.
Martin, short answer.
If you're part of a listed companies like the case mentioned, there's a lot of change. It changed infrastructure, it changed process, mentioned in the financial reporting, but also your ability to promote your company. You have a brand name in the market, you are more visible, you have the funds to invest more in growth, and speed counts in those markets. Also, your information culture might change. You're much more open to external investors, but you need to be 100% regulatory compliant towards the regulator, whether it's the Luxembourg regulator or the regulator here in Germany, the BaFin, or the SEC in the US. So there's a lot of change, and also with your leadership team, typically one thing is added, which is the supervisory board in a two-tier system. So it gets a bit more formal and more, you need to document more as the time before.
Right. Thank you very much. We're running a bit short on time. Thank you guys for being here. Sebastian, Jannis, Martin, I think you will be around for a couple of more minutes in case there are any questions from the audience. Otherwise, thank you for listening. Enjoy your time here at Heureka today. And again, thanks for being here, guys.
Thank you.
Thank you.
Thanks.
Thank you.